Fair Isaac Corporation is down almost 15% today after Fannie and Freddie have embraced VantageScore 4.0. In the past, to get a loan, Fannie and Freddie would make you use a FICO score. However, now that is not the case. You do not have to use a FICO score, and you can instead use VantageScore 4.0, which has caused the stock to drop a lot because of increased pressures over competition in FICO's business, in which FICO uses a subscription-based model for people to use their FICO credit score to identify how creditworthy they are able to get loans, which offers FICO a pretty good recurring revenue stream. However, that might be broken up due to this huge news. So with that being said, I'm going to be using my 7-step stock analysis, which is my 7 key metrics to determine the financial health of FICO company. And after that, I'm going to be using my intrinsic value calculator to determine what price I'd be willing to pay for FICO and to see if we should be buying this stock today. My first 2 key metrics are based on the valuation of the company, and these are both the PE ratios. However, the first one is going to be the trailing PE ratio, which is the price of the stock divided by the earnings per share over the last 12 months. So this is taking a look at the past earnings per share, while the forward PE ratio is actually looking at the next 12 months of earnings per share. So forward PE ratio is in the future, trailing PE ratio is in the past, the valuation of this company. So looking at Fair Isaac Corporation, I want to see the trailing PE ratio greater than 0. And as we can see here, we have a trailing PE ratio at about 80.53. So this is pretty high, especially when compared to the stock market. However, I think after this big drop today, it's at about 65. So at least with this big drop today, the trailing PE ratio has gone down a little bit. But comparing that to the S&P 500, which is the 500 biggest companies on the US stock market, this looks pretty high. With the stock market at about a 20 to 25 PE ratio, this right now is at about a 65 PE ratio. So it's about double to 3 times more overvalued than the stock market. But it doesn't mean we shouldn't buy this company. And looking at the forward PE ratio, we want this less than 30, showing that in the future we have a pretty decent valuation that's in line with the market. However, if we take a look here, it's a forward PE ratio of about 51.28. So this is about double the stock market. So this company is definitely trading at a high valuation, even with the big drop today. But I don't know, that doesn't mean we shouldn't buy this company. So now if we get into the sales growth or the revenue growth rate of Fair Isaac Corp, I want to see a greater than 5% revenue growth rate each year over the past 5 years. As we can see here, they've been increasing this revenue pretty consistently. Due to their subscription-based model, they can have recurring revenue basically every single quarter. It's going to go up, especially if they don't lose subscribers. They're definitely going to make and generate more money each quarter. So as we can see here, it's definitely growing at a decent rate. While it's not insanely fast, they've been picking up that revenue growth rate over the past few years. And over the past 5 years, it's been growing at about an 8 to 10% rate. So this is greater than the 5% rate that we want, and is actually growing at a pretty decent revenue growth rate. So the sales of the company looks good. Now taking a look at the net income of Fair Isaac Corp, we can see that it is also doing the same thing as their revenue growth, which we also want this greater than 5% each year. And as we can see here, it's definitely growing greater than 5% since 2020. It's growing at about a 20 to 22% rate each year. So this is very good growth out of FICO, and I really like this growth rate from FICO. Now taking a look at the shares outstanding, we want to see them decreasing their shares outstanding, because if they decrease their shares outstanding, automatically we're going to get more earnings per share. So the earnings per share will go up even if they don't increase their earnings. If they buy back shares, we're actually going to own more earnings from the company, since we'll own a greater percentage of the company if they buy back shares. And as we can see here, they have been buying back shares at a pretty good rate. Although it's not a consistent buyback rate, it is being bought back by the company, so it looks pretty good. And over time, it's actually been bought back pretty good. They bought almost 50% in the past 15 years, so that's a pretty good rate for FICO. And I really like that about this company, because they're giving us a greater return as they buy back shares, and also their earnings growth is at a greater than 20%. So our returns for us investors are going to be very good because of this. Now we want to take a look at the balance sheet of FICO, and we want the total debt to equity ratio less than 50%. Which means that they have more than double the amount of equity compared to their debt. However, if we take a look here, they actually don't have a total debt to equity ratio, because if we take a look at the book value per share, it's actually negative. So they technically don't have any equity, which I don't necessarily know why. You probably should do more research if you want to buy this company, why they don't have equity or have a book value. It's probably something to do with their accounting, so it's not that big of a worry. But once again, if we take a look at the total debt, they have about $2.55 billion in debt. So that's a little bit worrying. But at least their income is about 500 million. They've been making about 500 million each year. So it's not the worst total debt to the income, but it's not good, because if they wanted to pay off all this debt, it would take them about 5 years. So it's not terrible, but it's also not very good for us, because they do have a decent amount of debt compared to the amount of net income they're creating. The final metric that I'm going to be looking at is the analyst expectations for their EPS growth rate. And over the next 5 years, we want to see a greater than 5% growth rate. And as we can see here, analysts actually expect them to grow at about a 25.9% rate. So they're expecting them to grow at a very fast rate. However, I do think that this might slow down because of the big news today that Freddie and Fannie might actually not be completely using FICO. This nonetheless is still really good growth rate in the future. Now, the final thing that I'm going to be doing is using my intrinsic value calculator that I created in order to determine the price I'd be willing to pay for FICO. The first thing I have to do is put in a future revenue growth rate that I think that they can grow at. As we saw earlier, they expected them to grow at about 25% rate for their earnings. So I'm thinking a fair revenue growth rate. I do think that it's definitely going to be less than 25%, because that's also the revenue. Over the past 10 years, they've been growing at about 10%, but over the past 5 years, they've been growing a bit faster at about 15 to 20%. So they've really increased this revenue, probably because of their subscription-based model. So I think a fair revenue growth rate in the future is actually 15% each year. I think that they could definitely reach that margin, and since analysts expect them to grow at 25% in earnings, I think 15% revenue growth rate is pretty reasonable. Now for the net profit margin. Their net profit margin has been anywhere from about 25 to 35%, and I think it's going to stay around there, and I think about a 30% rate is good. I don't think a 35% net profit margin, I think that's too high, especially with the competition that is going against FICO as of now because of that huge news, so I think 30% is reasonable. Now for the future PE ratio. We saw earlier that they're trading at a very high PE ratio at about 60 to 65, but their future PE ratio was about 50. So I think that a fair PE ratio for Fair Isaac, I think they definitely deserve a premium compared to the S&P 500, which is at about 25. So I'm going to put a 27 PE ratio. Since they have a pretty big moat, and just because of their company, I think they deserve a 27 PE ratio. Now the final thing I have to do is use the shares outstanding. I am going to assume what they're going to buy back in the future. And they bought back a pretty decent amount over the past few years. They bought back 50% in 15 years. So they've been buying back at a pretty good rate. So I think they could buy back about 3% each year. I think that's a fair value for the shares outstanding. And with that being said, I get a future share price in 10 years at about $3,352. And if you bought this today at $1,550, you can make about 11.63% return. So as of today, I'm personally not buying FICO. But if say the company got to like $1,350, I would actually probably buy a share or two. I think $1,350 to $1,400 is probably where I'd be starting a position in this company, because I really like this company, and just because of the moat that they have. However, because of their competitive advantage deteriorating, I am slightly worried about that. I'd still buy this company. So with that being said, I think a fair value price to buy is about $1,350, where you'd make about a 15% return. But if you want to make about a 12% return, I think if you bought it today, you would definitely make a outperforming return on your investment. So whatever your margin of safety is determines where you should buy it. But me personally, with my margin of safety at about 15%, I'm going to be buying it in the 1300s if it reaches 1300. So thank you guys for watching this video. Please subscribe, hit the like button, comment down below what stock you want me to analyze next, and see ya.